Gautam Duggad, head of institutional research with Motilal Oswal, joins us now. Let's take a conversation forward. Gautam, it's been a very news-heavy year, and net Nifty has given almost a 8-9% return. So one look at the sequence of events, which is there was election, there was a lot of news on the global front, flows have been decent. Is 8% return a satisfactory return?
Hi, Nikunj. Good morning and advance best wishes for 2025 to you and your viewers. So, look, Nikunj, if 1 year back you had looked at the markets and someone had told you that this is a sequence of events which will happen, somewhere in June, you would expect Mr. Modi to come back, but with much less number of seats than what was anticipated. And then you had a series of geopolitical tensions with two wars, US elections, inflation being so high. And despite that, on a trailing 1 year basis, right now Nifty is up 12%, and mid cap and small cap indices are up 25 and 22%. I think you would have taken it, right? See, look, what has happened is while globally things have been quite turbulent, India, despite the higher base of previous 2 years, has somehow managed to, deliver a reasonable returns on a trailing 12-month basis for large caps, while of course mid cap and small cap have been stupendous. Do also remember the fact that after 4 years of a very strong earnings performance of 21% CAGR between FY20 to 24, Nikunj, this is the first year of a single-digit earnings growth in 5 years. It's almost flattish. Right now, we're expecting 5% growth. We will see whether this 5% hold up in the next 6 months or not. So even if that 5% comes about, you will still call it as a very flattish performance after what we have seen for last 4 years. So given all of this, with geopolitical tensions and, views around rates changing every now and then, I would take this 12% return of Nifty on a 12-month basis and hope for some recovery in earnings in FY26. So from there, then we can build up next 2 or 3 years of a good mid-teens kind of a returns possibility.
Okay, so mid-teen kind of possibility is what you are hoping for in 2025. Hi, Gautam. This is Anisha also joining in the conversation. Just wanted to get a better sense from you with respect to the kind of sectoral breakup that we have at our hands. I think you recently downgraded autos as well. You are underweight when it comes to metals, and these are the two segments that markets still are a bit divided on because metal does have a couple of tailwinds to really watch out for. What exactly is your thesis on metals and autos?
So, Auto Anisha, we've been overweight for 2 years, large part of 2023 and first half of 2024. It's somewhere in July we downgraded the sector to underweight as we were seeing pressures emerging on two fronts. One is volume and second on margins. So if you look at auto performance in terms of earnings in Nifty, between FY21 to FY24, the auto earnings in Nifty went up from 20,000 crores to close to 60,000 crores, which is a very strong performance on a low base. So we are expecting the margins to normalize now in FY25 second half as well as FY26. And we were expecting single-digit earnings growth for auto in FY25. And telltale signs of that were visible in the monthly numbers of both two-wheelers as well as four-wheelers, which is when we downgraded auto to underweight in July. And we only have M&M and TVS in our model portfolio. As regards metals, Anisha, there has been no clear trend which is visible in commodity prices. It's been in a downward range for some time now. And if you recall, FY22 was a blockbuster year for metals in terms of earnings. It is almost an outlier year if you look at the trend of metal earnings performance over the last 5-6 years. Despite the recovery in FY26 and FY27, I'm afraid to say that metals earnings in FY27 will still be lesser than FY22, which is okay for a deep cyclical sector. This is not something unusual. But, the news flow around metals, which is what drives the prices, has not been very conducive either, which is why we've been underweight on commodities, both oil and gas and metals. Our larger overweight resides in IT, consumer discretionary, industrials, real estate, and financials.
Gautam, hi. I think the year gone by has definitely oscillated between sort of hope and despair when it comes to the entire IT sector. So, what's in store for the sector ahead? Because we have seen that revival in discretionary technology spending. That's also very contingent as to what happens with the overall macros in the US markets. We have seen a phenomenal rally play out in a lot of those tech heavy stocks in the US. What does that signify for our own IT sector?
Yeah, so we've been quite, lucky in IT weights because we were underweight in IT till about April. And as I was answering Anisha's question on auto, July is the month when we turned overweight on IT. We raised our weight from 8% to 11, and then in October we doubled down. The reason was twofold: bottoms up as well as top down. The top down reason was very clear because Nifty itself was trading at 22 times. The rest of the broader market was very expensive. So we thought a little bit of defensive allocation will not hurt us. And bottoms up reason was we were expecting IT spends to accelerate in second half of FY25. As we speak today, we are expecting the IT budgets to improve as we move forward in the beginning of CY25. Secondly, the US banks are making a big comeback. So a lot of the projects which were shelved, we are seeing some resumption happening there. So that is why we increased the IT weight slightly ahead of the expectation around acceleration in IT spending. But our positions in IT are very different. We have a much larger weight on mid caps like Persistent and Coforge, which we added in October. Our single largest large cap call is on HCL Tech, followed by LTIM. So we don't have TCS, we don't have Wipro. So this 15% weight resides in just 5 companies, and which are very chunky weights, especially for mid caps like Persistent, all which have done very well. We expect 2025 to be equally strong for IT, while percentage returns may not mirror what we have seen in CY24. But we expect it to still outperform the markets in calendar year 25 too.
Okay. But the growth for the IT sector, Gautam, is 8 to 10%. Now, for a sector which is growing at 8 to 10%, what should be the right P multiple?
Nikunj bhai, in IT, the growth is not linear for every companies. If you look at large cap, they are oscillating between 5 to 8%, as you rightly pointed out. But the real fun in IT for last 3 years, or maybe even 4 years, has been in the mid caps. Nikunj, if I take you back last 10, 15, 20 years, and if you see the plot of IT large cap versus mid cap valuations, you will notice that every 3 years, the mid cap IT goes into premium and discount, right? Every 3 years, it moves into premium, then it moves into discount versus large cap. This is the first period of 4 consecutive years where IT mid caps have traded at a premium to large cap. And they've not only traded at a premium, the premium has expanded. And the reason is not very difficult to find. The reason is there in the differential in growth rates. If you look at the mid cap IT, the names which I just mentioned in our model portfolio, their growth rates of 3x are 3x of large caps, and which is why the market has ascribed them very high P multiples. Secondly, on the cash flow front, till about 3, 4 years back, the gap on free cash flow conversion of profits used to be very high between large cap and mid cap. That gap has narrowed down a bit. And broadly, Nikunj, if you look at any sector in India, not just IT, the learning of last 2 years has been in India, wherever there has been a growth differential, the market has been very generous in ascribing higher PE multiples. So whether it is B2C companies like Zomato, Trend, or Varun Beverages, or in IT, or in EMS, whichever sector you take, the market has been very generous in, re-rating the growth. And which is why our style has been more tilted towards growth. And that's why while we have a large overweight on IT, it is predominantly into the mid caps.
So where are these clusters of growth where re-rating is still left? I mean, now it's hard to find too many treasures in this market. But are there any growth pockets where markets can still re-rate those stocks, both in terms of EPS and in terms of PE?
So PE re-rating looks very difficult now, or maybe very limited in few pockets here and there. You're right, because we are right now trading at 30 times 1 year forward on mid cap, 24 times 1 year forward on small cap, and about 19 and a half, 19 to 20 times on Nifty. So clearly, market has been very, very generous, especially in the broader markets, in giving a much higher P multiple. I mean, if I give you just one example, if you look at the EMS companies, the large ones and mid ones, in the last 1 year, some of them have gone up 3x to 4x, while earnings might have doubled. So while they started with expensive valuations, given the extended visibility of growth, the market has re-rated them even higher from where they began a year back. Today, if you look at the possibilities of P re-rating, it looks very difficult. So the most obvious sector, which I'm sure your other guests over the months, week, quarters have been talking about, is financials, which is where growth is decent and valuations are cheap now, especially the large cap banks. Mild possibility of re-rating, Nikunj, in my view, still exists in capital market stocks. We've just put out a very detailed thematic report covering 15 new stocks about 2-3 weeks back. I think this is a segment which has emerged very strongly in the last 12-24 months. And all the mid to large, long end factors for this sector are very favorable, whether it is the financialization of savings, the adoption of technology, the proliferation in demat accounts. So various subsegments in Indian capital market space, whether it is exchanges, wealth managers, AMCs, the intermediaries, depositories, brokers, we feel quite positive on this space. While there could be some intermittent jugs because the regulations keep coming in here and there, but from a 3 to 5 year perspective, we think there is some possibility of re-rating and good compounding returns that you can still expect in capital market space.
Okay, capital market space is looking good, but Gautam, what's the view on real estate after the run-up, and is it better to play the sector directly through the real estate stocks, or maybe cement and building materials is also something which looks better on the value parameter?
So Anisha, that has not worked out for last 3 years actually. The best way to play real estate is through real estate stock. That's what we believed in the last 2 years. We have a massive overweight on real estate in our model portfolio for last 3 years now. And the problem with playing through roundabout way of using a cement or using a building material is that the visibility of real estate growth in some of these ancillary spaces sometimes get delayed depending on the pace of the construction. So people have been expecting the re-rating or maybe even earnings growth, first of all, forget re-rating, in some of these building material stocks for last 2-3 years now. Do remember real estate and hotels both have a very similar characteristics in terms of the duration of cycle. 2008 was the peak of both real estate and hotel cycle, and it took them 12 years to come back to that upcycle. If you look at the largest hotel company in India and check their EBITDA of 2008 and 2018, they're virtually similar. So our view is that in both hotels and real estate, we are somewhere in the middle of the upcycle. The demand supply dynamics in terms of demand CAGR versus supply CAGR is very predominantly tilted in favor of demand, which is why a year back also, when a lot of the people were raising questions on valuations of these two sectors, we were of the view that given the duration of the upcycle, which is still left in the space, we continue to like them. So we have preference towards both hotels and real estate, which occupy more than 5-6% in our model portfolio. So clearly, the fundamentals of the space have been very strong, and given the way things are unfolding, we think that at least 2-3 years of upcycle is still left in the spaces.
So Gautam, if somebody has to build a portfolio for 2025, and there's a strategy note which you've come up with, what should be the broader framework in one should work with?
So Nikunj, look, 2025 looks to be a difficult year ahead, given the way macros, both domestic as well as global, are shaping up, and the scarcity in earnings growth suddenly in 2025. While at an aggregate level, earnings growth is just 5% for 2025 FY. And if you are to be a little more generous, you will look at X commodities and growth looks slightly better at 10-11%. But that 10-11% is still lesser than 20% X of commodities that we eked out in FY24. So let's assume that FY26 gives you 15% earnings growth, which is an EPS of somewhere close to 1240 that we are working with right now for FY26 Nifty. Now, given where markets are, possibility of re-rating looks very difficult, though one should never say no, given the way the flows are. This year we've already crossed $60 billion in domestic flows, even though FII flows are as good as zero. So if, the 60 becomes $50 billion also in CY25, you're talking about a possibility of at least 10 to 15% kind of a return from a 12 to 15 month perspective. Now, with that as a broader top-down brush, if you are to construct a portfolio, you have to look at two things. One is within an overall moderating earnings growth regime, which are the sectors where earnings is slightly better. So we already discussed 3 to 4 sectors where earnings are better, which is financials, IT, EMS, industrials, real estate, and some bit of consumer discretion. Consumer is an ocean, while staples is going through a prolonged period of slowdown. Some part of discretionary sectors within the consumption basket is still doing reasonably well. Names like jewelry, hotel, and some of the other discretionary segments like trend. So my approach to, and which is what we've been doing now for a few years, is to give higher weight to earnings visibility. While I'm not disregarding valuations, but valuations is not the starting point for us when we are constructing our portfolio. And second, incrementally, our bias has been more towards large cap. So today, if you look at our portfolio, 75% of our model portfolio is in large cap. So that is the broad framework with which we will work, and then try and add some incrementally more defensive names. So we have Bharti. Maybe this is a time to increase weight on Reliance a little bit, and HDFC Bank, which we have already moved from underweight to overweight. We think there is a possibility to raise weight further on HDFC Bank. So that is the way with which we will look at constructing portfolio for calendar year 25.
Fantastic answer. Appreciate your time and best wishes for 2025.
Same to you, Nikunj. Thank you.
If you like this video, then like, share and subscribe to ET Now.